once long before Wall Street packaged it as shareholder value. This practice had another name: manipulation. If a corporation used its own cash to pump up its stock price, that wasn't brilliant strategy. It was considered fraud. Executives could be jailed, companies punished, reputations destroyed. Companies purchasing their own shares to lift their value have become the dominant engine of corporate America. They inflate markets, supercharge CEO compensation, and shift trillions to shareholders, all without inventing a product or hiring a worker. So how did something once treated as a crime turn into the backbone of modern capitalism? The tale of stock buybacks begins with a collapse. During the roaring 1920s, markets behaved like giant gambling halls. Executives rigged their own stock prices, bankers cut insider deals, and fortunes rose and fell in hours. The New York Stock Exchange was a stage of illusions, and everyone wanted the spotlight. When the crash struck in 1929, the tricks behind the boom became weapons. Companies had been using their own reserves to buy shares and keep prices afloat, giving investors a false sense of strength. As panic surged, those same firms were forced to dump shares to stay alive, worsening the collapse. By 1933, faith in capitalism had evaporated. Factories shut down, banks collapsed. A quarter of Americans were unemployed. People no longer trusted Wall Street or the myth of a self-regulating market. In response, President Franklin D. Roosevelt's administration did something revolutionary. It rewrote the rules of capitalism. The Securities Exchange Act of 1934 created the SEC and declared something unmistakable: companies would no longer be allowed to manipulate their own stock prices. The principle was simple: markets should reflect value, not vanity. For the next 50 years, stock buybacks were essentially forbidden. Not explicitly banned by name, but outlawed by definition. If a company repurchased shares to influence price, it could be prosecuted for manipulation. And so, for half a century, the American economy grew without this financial shortcut. Corporations reinvested profits in innovation, equipment, and employees. CEOs were builders, not financial engineers. The stock market measured industrial might, not accounting tricks. The system wasn't perfect, but it produced. Then one idea changed it all. In the 1970s, a quiet intellectual shift began, not on factory floors but in academic halls. Economists like Milton Friedman argued that a company's only obligation was to maximize shareholder value. To corporate leaders, this was liberation. They had spent decades prioritizing stability and employment. Now they could obsess over the only metric that mattered: the stock price. By the 1980s, that philosophy found its political match. Ronald Reagan entered office promising deregulation, smaller government, and unwavering belief in the market. Wall Street rose to dominance. Investors demanded higher returns. CEOs wanted fewer rules. Corporations wanted a faster way to drive stock prices higher without the slow work of real expansion. They didn't want to rebuild what they made. They wanted to redefine how it appeared. Then came 1982. Without fanfare, the SEC introduced Rule 10b-18, a single-page regulation that would quietly reshape capitalism for decades. It created a safe harbor, allowing companies to buy back their own stock without being charged with manipulation, as long as they stayed within loose daily limits. No congressional debate, no national conversation, just one subtle regulatory shift in the middle of the Reagan Revolution. In one move, the SEC legalized what earlier generations of regulators had prohibited: the ability of corporations to manipulate their own stock prices, as long as they framed it as returning value to shareholders. The impact was immediate and enormous. Before 1982, buybacks were rare. Companies paid dividends, funded research, and expanded production. After 1982, buybacks exploded. First a trickle, a few billion a year, then a wave. By the 1990s, buybacks surpassed $100 billion annually. By the 2000s, they became standard corporate behavior. By the 2010s, they reached over $1 trillion a year. The math was simple and devastating. When a company buys back its own shares, the total number of shares shrinks. With fewer shares, earnings per share automatically rise, even if actual profits stay flat. On paper, the company looks stronger. Stock prices climb. Executive bonuses, almost always tied to stock performance, skyrocket. No new innovations, no new hires, just arithmetic. This wasn't capitalism at work. It was financial cosmetics. Buybacks became the corporate equivalent of a facelift, a way to appear young and valuable without changing anything underneath, and Wall Street adored it. By the 1990s, tech companies refined the tactic into an art. Firms loaded with stock option compensation bought back shares to cancel out the dilution from their own bonus packages, effectively using shareholder money to inflate executive pay. Then came 2008. After the financial meltdown, taxpayers rescued the banks, and once stable again, those same institutions spent the following decade using profits and often borrowed cash to buy back stock. Between 2009 and 2019, the top 500 U.S. corporations spent over $6 trillion on buybacks, more than they spent on new investment. Buybacks don't build resilience, they build illusions. They make markets look strong until the illusion shatters. They make companies look wealthy until reality arrives. Yet even as critics demanded reform, Wall Street defended buybacks as efficient. In a system obsessed with stock prices, nothing mattered more than appearances. By the time buybacks became routine, the meaning of corporate success had transformed. Growth no longer meant building factories, inventing products, or creating ideas. It meant shrinking share counts and hitting quarterly targets. The economy turned inward, companies feeding on their own equity, investors chasing reflections of wealth instead of its creation. Governments adapted too. Rising stock prices became evidence of stability. Leaders pointed to market charts as proof of prosperity. Central banks treated them as vital signs. In the new order, as long as stocks rose, no one dared admit the patient was sick. But illusions endure only as long as belief does. When buybacks first surged in the 1980s, supporters framed them as efficient capital distribution. If a company had surplus cash, why not return it to shareholders instead of wasting it? On paper, the logic was sound. In practice, it drained the system. Cash that could have strengthened companies was funneled to shareholders and executives instead. Research slowed, wages stagnated, productivity flatlined. Executives grew wealthier than ever, not because they led better, but because the rules let them earn higher bonuses. Their pay packages were tied to stock prices, and buybacks were the easiest way to push those prices up. That's the dark genius of legalized manipulation. It doesn't break the system, it becomes the system. By 2018, U.S. corporations spent more on buybacks than on capital investment. Apple, Microsoft, and ExxonMobil alone were responsible for more than 20% of all repurchases. Entire industries transformed into stock management machines. Airlines, retailers, even once innovative tech firms became financial entities whose main product wasn't goods or services, but shareholder returns. The 2008 crisis should have ended it. When the economy imploded, the system's fragility was obvious. But instead of structural reform, bailouts restored the illusion. Central banks injected markets with cheap money. Borrowing became nearly free. Companies borrowed heavily, not to innovate but to buy their own stock. Between 2010 and 2020, U.S. corporations spent over $7 trillion on buybacks, equal to the GDP of Japan. The richest 1%, who hold more than half the stock market, captured nearly all of it. Workers got layoffs, executives got record bonuses, and with that, the cycle restarted, even larger. When the pandemic struck, corporations were more indebted than ever. Revenues evaporated, and the same companies that had spent years inflating their own shares rushed for public bailouts. The money that could have built resilience had vanished, converted into stock highs and quarterly paydays. The illusion was complete. Profit replaced value, and survival became next quarter's concern. Buybacks weren't just a financial tactic anymore. They were a mindset, a symbol of a system that rewards extraction over creation, speed over stability. The impact on inequality was staggering. Every repurchase enriched those who already owned shares, the wealthiest 10% of Americans, who now hold nearly 90% of the stock market. For everyone else, wages lagged behind inflation, savings shrank, and the path to prosperity lost its steps. As inequality widened, markets became dependent on buybacks. They weren't an outcome of prosperity, they were its illusion. Without them, prices slipped, so companies borrowed even more to keep them going. Between 2010 and 2020, corporate debt doubled, balance sheets swelled, profits appeared endless, because the system had learned to recycle capital faster than it could create it. Manipulation, once outlawed, had become monetary policy. When markets falter, it isn't just investors who panic. Governments do too. Institutions that once banned manipulation now rely on it to maintain confidence. High stock prices soothe the public, support pensions, and make leaders look capable. And so the illusion expands, quietly, elegantly, and dangerously. If this sounds familiar, it should. The 1920s ran on the same fuel: cheap credit, inflated stocks, and blind faith in limitless growth. When a system values appearances over productivity, when it rewards the few for inflating numbers that the many rely on, when capital stops circulating and starts concentrating, collapse becomes a question of timing. Buybacks were meant to signal strength, proof that companies believed in their future. Instead, they exposed that they no longer needed to. Why build tomorrow when you can buy yesterday and call it profit? Here lies the irony. The mechanism that once helped destroy markets is now celebrated for sustaining them. What was once called manipulation is now praised as efficiency. What was illegal is now the engine of economic growth. And history gives a clear warning. The deeper you study buybacks, the more they resemble every bubble before them, an economy chasing its own reflection. The more we depend on rising prices for stability, the more fragile that stability becomes. It's not real growth, it's gravity postponed. And when the cycle finally snaps, when confidence collapses under its own weight, the fallout will feel familiar. Not a crash of innovation, but a crash of trust. The kind that destroys not just wealth, but faith in the entire system. Buybacks are more than a story of corporate greed. They're a story of how power rewrites rules. In 1934, manipulation was banned because it wrecked markets. In 1982, it was legalized because it propped them up. That's not evolution, it's regression disguised as sophistication. The costliest illusion in history isn't a bubble, it's belief. Belief that you can manufacture confidence forever, that numbers on a screen can replace the fundamentals that once built the system. The next reckoning won't begin with a crash, but with a realization, the moment people stop mistaking inflated prices for prosperity. When that belief collapses, every illusion built on it will fall. Stock buybacks were legalized to make markets efficient, but efficiency without purpose is simply decay, accelerated. The system that once criminalized manipulation now depends on it. And what we're left with isn't capitalism, it's choreography, a carefully staged performance designed to make decline look like success. If this shifted your perspective, hit subscribe. History has the answers, and I'll show you where to find them.